Today on the Bar Business Podcast, master the October tax strategy window and figure out what you need to do before December 31st to maximize your 2025 tax savings. Learn the 90-day cash flow forecast and how to prevent a crash crunch in January when everything slows down. And master the end-of-the-year inventory audit that will help you turn dead stock into cash and preserve margins. Hello and welcome to the Bar Business Podcast, where we help bar owners increase profits, attract loyal guests, and simplify operations so you can avoid burnout and finally enjoy your life outside of your bar. I'm your host, Chris Schneider, the Bar Business Coach. Today on the Bar Business Podcast, we're diving into all things about the end of the year. And I know it's just the beginning of October, but beginning of October is really when we need to start thinking about end of year things. So we're going to talk three Q4 or fourth quarter power moves. We're going to look at some tax timing. We're going to look at some proactive cash flow, I should say, and how to do a practical inventory audit that is going to help protect your profit. And so when we talk fourth quarter, we're talking October, November, December, which is most businesses that are running on a calendar year anywhere in the world. This is your fourth quarter. And for bars and restaurants, the fourth quarter is usually going to be a little bit more than 25% of the business due to your holiday parties in December. Now, what's the big thing that we're looking for on the horizon? Well, January is slow, right? And there are a few exceptions around the world. There are a few exceptions in certain areas. But generally speaking, January is not a great month for anyone in the bar industry. So we want to have a great end of the year so that we can have a good beginning of the year, even though we already know we're not going to sell what we want to at the beginning of the year. So let's break this down. We're going to start with our October tax strategy and how to start looking at the end of the year. But I want you to remember, January is still 3 months away. So we have time to do all that. And that's why we're talking about this today. So let's break down this October tax strategy. Now, we want to move sensitive actions that we have to do by the end of the year into October and November. Now, why do we want to do that? Well, because end of the year is busy, right? We just talked about how Q4 is one of the busier times in hospitality in general because of our Decembers, because of all the holiday parties that we host. And so at the end of December, when you got Christmas and then you're off and you had a bunch of parties right before and then you're going into New Year's Eve, that's not the time to plan your end of year. The time to start working on it is now. So what do we want to look at as potentially places where we can get ourselves some tax benefits if we're in the United States? Well, charitable giving, right? That's a great one. If you have a bunch of profit and you don't want to pay taxes on it, maybe you want to give some money to charity. And that's obviously up to you, but that can help defer some taxes. You could also look at, do I need to purchase equipment so I can expense some things? Do I have excess income that I may want to use to purchase equipment? And so especially big pieces of equipment, this can be a great time to do it. Another thing to think about is, as an owner in the United States, if you have a IRA, your contributions are going to be due for this year by April 15th. So you do have a little bit of first quarter next year to really plan out those contributions. But it's best to plan now and to allocate cash towards your retirement so that you're not scrambling to do that later. It's also when you need to sit down with your CPA and go over all these tax strategies, because I am not your CPA, so this is very generic advice, but sit down with your tax planner, your tax preparer, and look at, are we expensing things? Are we going to 179 them, right? Are we going to put things on the P&L? Are we going to put them on the balance sheet? What are the different rules there? And that's something, again, you should talk to your CPA about. Generally speaking, the IRS de minimis rule is $2,500. So if it's a piece of equipment less than $2,500, you can expense it. It's greater than $2,500. A lot of times that's going to be held as an asset on your balance sheet, but the specifics of that can get very detailed. So make sure you're talking to your tax preparer. But let's talk about what type of depreciation, right? Because there's Section 179 that allows you to expense things. There's bonus depreciation. Depending on your specific strategy, you might want to buy a bunch of equipment and expense it this year, or you might want to buy some equipment and expense it over time, or there may not be a reason to buy equipment for your tax scenario. So talk with your tax preparer and figure out these things. Really, I'm not giving you any answers on this part. I'm just giving you questions. So I would say if you have the time, book a 30-minute call with your CPA or your tax preparer to go over these items and really plan out the end of year taxes and how to handle your taxes to be in the best situation going into next year. Now, our second thing that I'm going to point out for end of year that we should be looking at is cash flow, right? We know Q1, January, is slow. So we want to save up some cash as we're in our busier season for most people here in the fall and early winter. So if you can, forecast out your sales to the extent you can. Look at last year, look at where your trends are this year, look at how this year compares to last year, and try to get an idea of what that looks like. If you need help with that, go in the show notes, book a strategy call with me. I'm more than happy to talk to you about different ways to forecast and some different tools that I use to make that easier. But what we want to do is essentially want to look at what are the inflows and outflows of our cash by week. And when we're talking about here, we're talking about forecasting cash flow, not forecasting revenue, right? Your inflows are going to be your sales, your deposits, your outflows, payroll, COGS, rent, utilities, debt service, all those types of things. And we're talking cash flow, remember, unlike profit and loss, where we're talking where loans don't come into play, loans do come into play for cash flow, because at the end of the year, we don't need to make sure we have a great profit to survive a slow January. We need to make sure we have a bunch of cash to survive a slow January. So figure out what that kind of looks like. Think about the holiday spikes, what those are going to do to your business and your cash. And then also think about, if you live in Florida, you don't have any weather issues, right? It might be a little cold, it might be a little rainy, but those will hurt you, but not too much. If you live in Minnesota, well, there's a lot of potential here for there to be snow, closures, different things going on. So make sure you're looking at what is the ability of weather and events to disrupt my forecast, disrupt what I think is going to happen this last part of the year. Set some cash guardrails, right? Have a minimum cash threshold. I used to do this a lot. Minimum cash thresholds, I really think, are the easiest way to manage your cash, right? And as the owner, especially if you're just the sole owner, you can choose not to pay yourself when the business doesn't have enough cash. It sucks, but it's a great way to build up some cash for January if you're worried about it. The other thing too is you can just pay yourself a little bit less and build up a lot of cash, in most cases, quite quickly. So remember, the whole point here, we want to figure out our cash flow. We want to have a plan for our cash flow so that when we get to January, February, and it's slower, we are in a better position. Based on some studies that I was looking at, if you determine your cash planning in October for the end of the year and the first part of next year versus in December when you're scrambling and trying to figure out how to improve cash flow in January and February, rather than saving for what you know will be slower cash flow, you're going to see a January, February cash flow improvement of 15 to 20% by planning ahead, according to the data. So make sure you're planning ahead on the cash flow. Last thing I want to throw at you for kind of next year's planning, do an inventory audit. Plan an inventory audit, right? Categorize your inventory, fast movers, slow movers. What is dead stock, right? Fast movers, we've talked a lot about days in inventory. Fast movers, most of your stuff should be 14 days in inventory, no more. Your slow movers, then you're looking at your 30 to 90-day items. Your dead stock, it's been sitting on it for more than 90 days. What can we do to get this out of here before the end of the year? Well, we can build conversion plays. So think about seasonal menus you can do for winter to pull through some of that dead stock. Think about featured cocktails or maybe a holiday cocktail list you could do to move some of that dead stock. And then look at staff incentives, contests that are triggered by selling items that use that dead stock, right? What we want to do here is look at our inventory, figure out where we are, and move everything we can out of this year that's been sitting in our liquor room doing us no good and turn that into cash by the end of the year. So to wrap us up for today, now is the time to start thinking about your taxes, your deductions, your retirement planning, whether or not you need to buy equipment, what that looks like. Get a hold of your tax professional and figure that out. Second thing to work on for end of the year, build a cash flow forecast for December, January, February. Make sure it aligns. Make sure that you're going to have sufficient cash saved up from this busier fourth quarter for what is traditionally a much slower first quarter. Third thing I want you to do, look at your inventory. Determine what's dead inventory. Determine what's good. Anything that you're not selling, come up with a way to move that in short order over the next few months. That about wraps it up for today. If you enjoyed today's insights, make sure you like, subscribe, and leave a review. If you are ready to take your bar to the next level, schedule a strategy session with me by clicking the link in the show notes below. Until next time, have a great day, and we will talk again later.